What's up, everybody? This is Sunpo, the Korean Bro. Today is 2024, June 3rd, and it's been quite a while since I did YouTube last time, and I've been a bit busy, and plus, on top of that, I got a bit tired of reading an article posted on mollyfood.com because my whole thoughts has changed a lot recently because of the book that I read, and the book that I'm reading currently is called The Intelligent Investor, and it has changed my thoughts on investing and my thoughts on author who works in mollyfood.com. And along with all of that, I've been a bit lazy lately, and so here I am, back again, and I'm trying to read a book. And the book that I'm reading is called The Intelligent Investor. And okay, anyway, all right. What I'm going to read from is 92, page 92. Okay. Mm. The choice of longer versus shorter maturities involves quite a different question. These Does the investor want to assure himself against decline in the price of his bonds, but the cost of a lower annual yield and loss of the possibility of an appreciable gain in principal value? We think it best to discuss this question in Chapter 8, Investor and Market Fluctuations. For a period of many years in the past, the only sensible bond that was and is unquestioned. They gave a higher return than other bond investment of first quality. They had a money back option and other privileges which added greatly to their attractiveness. In our earlier editions, we had an entire chapter entitled U.S. Savings Bonds, a boon to investors. As Bouchet pointed out, U.S. savings bonds still possess certain unique merits that make them as suitable purchases by any individual than $10,000 to put into bonds. We think they are still the easiest and the best choice, but those with larger funds may find other mediums more desirable. Let us list a few major types of bonds that deserve investor consideration and discuss them briefly with respect to general description, safety, yield, market price, risk, income tax status, and other features. Mm, it's all about bonds, which is something that I don't buy. So we'll just keep on this and move on to commentary on chapter 4. Okay, when you leave it to change, then all of a sudden you don't have any more luck. How aggressive should your portfolio be? It says Graham depends less on what kind of investment you own than what kind of investor you are. There are two ways to be an intelligent investor: by continually researching, selecting, and monitoring a dynamic mix of stocks, bonds, and mutual funds, or by creating a permanent portfolio that runs on autopilot and requires no further effort, but generates very little excitement. Graham calls the first approach active or enterprising. It takes lots of time and loads of energy. The passive or defensive strategy takes little time or effort but requires an almost authentic detachment from the alluring hullabaloo of the market. As an investment thinker, Charles Ellis has explained, the enterprising approach is physically and intellectually taxing, while the defensive approach is emotionally demanding. If you have time to spare or highly competitive, think like a sports fan and relish a complicated intellectual challenge. Then the active approach is up your alley. If you always feel rushed, crave simplicity, and don't relish thinking about money, then the passive approach is for you. Some people will feel more comfortable combining both methods, creating a portfolio that is mainly active and partly passive, or vice versa. Both approaches are equally intelligent, and you can be successful with either. But when if you know yourself well enough to pick the right one, stick with it over the course of your investing lifetime, and keep your emotions under control. Graham's distinction between active and passive investors is another of his reminders that financial risk lies not only where most of us look for it, in the economy or in our investment, but also within ourselves. Hmm. Okay. Hmm. Let's see what new articles we have. One AI stock outpaced Nvidia by nearly 300% is still a strong buy. Okay, artificial intelligence is driving massive demand for data center computing power, while Nvidia enjoys an incredible ride. One company has significantly outpaced it. The big question is whether there is still room for this stock to run. Most investors may not have heard of Vertiv, but it contributes significantly to the AI process. Companies like Alphabet, Microsoft, and Nvidia soak up a lot of attention in the artificial intelligence race. The first two because they invest in public-facing products like ChatGPT and the generative AI chatbot Gemini. In the case of Nvidia, that's due to its indispensable chips and the stock's incredible performance. But don't forget about what is behind the curtain. A number of smaller, lesser-known companies also play key roles in AI development. Let's learn about one of them. Why are data centers important? Okay, NVIDIA's recent success is due to its data center revenue, which reached $22.6 billion last quarter, an astounding 427% year over year growth rate. Okay. Why are data centers such a big deal? Data centers are critical infrastructure to store, manage, and process vast amounts of information. They enable cloud based applications, e commerce, and much more. Here are some fun data center facts. There are over 10,000 data centers globally, with more than 5,300 in the US. The average data center is around 100,000 square feet. While some are small, those built by hyperscalers like Amazon, Alphabet, and Microsoft can occupy more than 1 million square feet. The largest US based data center, tracking in at 4.6 million square feet, is located in Oregon and operated by Meta Platforms. Experts expect more than 120 hyperscale centers to come online annually for a decade. One plan reported by Reuters is a Microsoft and OpenAI partnership for a $100 billion project dubbed Stargate. These massive complexes aren't just empty vessels with servers stacked inside. They require infrastructure such as racking, enclosures, power systems, temperature management components, switches, software, and maintenance. Vertiv Holdings is a leading supplier of this infrastructure, and increased demand made it one of the market's hottest stocks over the past year, as shown below. Is Vertiv Holdings still a buy? The question is whether there is a gas left in the tank. 2023 was a huge year for Vertiv. Revenue rose 20% to $6.9 million, and margins expanded. The Vertiv reported gross and operating margins of 35% and 13%, respectively, compared to 28% and 4% in 2022. Expanding margins show that Vertiv has pricing power in the industry due to ballooning demand. They also show that the company's business model will become even more profitable as it scales. The company used $600 million of its cash to repurchase stock in the first quarter of 2024 at an average price of $66 per share, showing Vertiv's confidence that its stock was undervalued. The stock trades for just over $100 per share now. Sales for quarter first hit $1.6 billion, an 8% growth rate. The growth doesn't seem impressive on the surface. However, the company's order volume grew by 60%. This means that customers placed 60% more orders than the previous year, and this revenue will be recognized in future quarters. Vertiv also reported a book-to-bill ratio of 1.5. This means that for every $1 of sales behind to a customer, Vertiv received $1.50 in new orders. Both metrics indicate significant, sustained growth, reinforcing the demand uptrend in data center infrastructure. The biggest risk for investors in Vertiv is stock's valuation. Its forward price earnings ratio is near 45, which seems high, but that isn't the whole story. Operating profits quadrupled in 2023 over 2022, moving from $223 million to $872 million. And diluted earnings skyrocketed from a negative $0.04 to a positive $1.19 per share. Vertiv also raised its full year 2024 guidance in quarter first. In quarter first 2023, the company forecast a 23% growth in operating income for 2024. Last quarter, up this to 28%. Is the UiPath stock still a buy now? UiPath's latest earnings report exceeded analyst expectation, which significantly reduced its revenue and operating profit guidance for the year. Its CEO also abruptly stepped down. So the robotic process automation company faces some major challenges. UiPath stock plunged 34% on May 3rd after the company released its latest earnings report. For the first quarter of fiscal 2025, which ended on April 30, the automation software provider's revenue rose 16% year over year to $335 million and beat analyst estimate by $2 million. Its adjusted EPS climbed $0.02 to $0.13 and cleared the consensus forecast by $0.01. Those headline numbers looked healthy, but UiPath also lowered its full year guidance and announced the abrupt resignation of its CEO, Rob Enslin. The double whammy of bad news resulted in the stock's worst single-day drop since its public debut in 2021, and now trades nearly 80% below its IPO price. So should contrary investors still buy this hated stock? Why is UiPath growth cooling? UiPath is the world's largest provider of robotic process automation services. Its software robots can be plugged into a company's existing software infrastructure to automate repetitive tasks like entering data, processing invoices, and onboarding customers. Its revenue surged 81% in fiscal 2021, which ended in January 2021, and grew 47% in fiscal 2022 as the pandemic drove more companies to cut costs, replace human workers, and accelerate their digital transformation. But in fiscal 2023, its revenue only increased 19% as inflation, rising interest rates, geopolitical conflicts, and other macro headwinds forced many companies to rein in their spending on big software upgrades. In fiscal 2024, its revenue increased 24% as it lapped the slowdown and the macro environment gradually stabilized. At the end of fiscal 2024, UiPath estimated its revenue would rise 19%. In fiscal 2025, when the first quarter, it cut that outlook to just 7 to 8% growth. During the conference call, CFO Ashim Gupta attributed that reduction to increased deal scrutiny and a longer scale cycle for its multi-year deals. It also reduced the midpoint of its full-year adjusted operating margin forecast from a 19% to 10%, compared to its adjusted operating margin of 18% in fiscal 2024. UiPath claims its problems are cyclical, but it faces stiff competition from a cloud giant Microsoft and Salesforce, which both integrate RPA tools into their own software. UiPath declining sales also coincide with the explosive growth of generative AI platforms, which could potentially replace its automation tools in the future. The sudden departure of its CEO raises more red flags. Rob Enslin joined UiPath in 2022 and initially shared a co-CEO role with founder Danny Dines, but in February 2024, Dines vacated the co-CEO position and transitioned to the Chief Innovation Officer role and handed the reins over to Enslin. That's why Enslin's departure was so shocking. He lasted less than 4 months. The CEO seat without Dines He also stepped down from the board. No reasons were provided for his sudden resignation, and Dines has to return as its CEO. Okay. Hmm. Nvidia shares are up over 100% so far in 2024 thanks to surging demand in AI. Chipotle investment in digital sales operations have helped build strong customer loyalty, translating to robust revenue and profit growth. Chipotle, okay, here we have Chipotle. The case for and against Chipotle. Chipotle best known for its tasty burrito wraps and bausch. With 40 million reward members, Chipotle has undoubtedly built a loyal customer following with strong brand equity. One of the ways that Chipotle has been able to capture the attention of so many consumers is due to the company's investment in digital sales strategies. Hmm. So, similar to Nvidia, Chipotle has been able to fund an extremely profitable operation. Its digital sales channels have helped fuel meaningful margin expansion, which in turn has flowed to the bottom line. Although these financial results are encouraging, Chipotle stock does carry some risk. Macroeconomic factors such as inflation, interest rate can impact just about any business. While Nvidia is certainly not immune to these factors, I would argue that a restaurant chain such as a Chipotle is more susceptible. Consumer discretionary trends are highly sensitive and can fluctuate from year to year. I encourage investors to think about that dynamic as it relates to long-term growth prospects. And the winner is the final pieces of this analysis revolves around valuation. As seen in the chart below, the price to earnings ratio of Chipotle and Nvidia illustrate vastly different trends. Over the last year, Chipotle's PE has risen considerably, now sitting at 65.7. By contrast, Nvidia's PE is far lower than it was a year ago. Another way of looking at this is understanding that while each stock has risen sharply in the last year, shares of Nvidia are technically cheaper than they were 12 months ago. Why? Because the company's earnings growth is outpacing the acceleration of the stock price. At the end of the day, Chipotle and Nvidia are two very different businesses. Mm. The fact of the matter is that Chipotle's fast casual dining is a luxury purchase, while the operating results above indicate that the company can grow. It's important to remember that Chipotle sells burritos. It's not exactly a proprietary business. On the contrary, Nvidia sells a product businesses of all sizes needed. And while competition exists, I think that there are stronger longer-term secular tailwinds fueling AI as opposed to the food industry. If anything, Chipotle could become a customer of Nvidia as the company doubles down on its technology investments. Stated differently, AI is so prolific that its applications span a variety of industry sectors, including food and beverage. I don't think the opposite is true though. I don't see many reasons why Nvidia would ever be Chipotle customer, considering the growth narrative surrounding AI coupled with Nvidia's attractive valuation. I think the company is the better option compared to Chipotle. So okay, the author thinks Nvidia is better option than Chipotle because considering all of the trend that's been going on right now, AI seems more attractive. Mm, okay, get it. Okay. The S&P's 500 return doesn't even come close to the monster gain of Home Depot. By successfully executing a strategy of opening new stores, sales were able to steadily rise. There is a buying opportunity here for investors who can maintain a long-term time horizon. Hmm. I'm not sure. I'm sure most investors know that the stock market is perhaps the best tool there is to build lasting wealth. For example, the S&P 500 has produced an annualized return of 10% historically. Given enough time, even relatively small sums of capital can turn huge amounts. But some individual businesses have fared much better. One top retailer stock has produced a total return of um, 2,714,000 since its initial public offering in 1981. If you invested just $1,000 in this company back then, you'd have a jaw dropping $27 million today. The business I just described is none other than Home Depot. Let's learn more about its rise over the years before considering its investment merits today. Doing the same thing. What's remarkable about Home Depot's historical performance is that it has come from a business that's in a boring industry. Through its network of massive warehouse stores, the company sells home improvement tools, pots, and supplies to both DIY and professional customers, something it was doing decades ago. Home Depot's founders made the right strategy decision early on to focus their resources on expanding the store footprint, basically replicating what worked to more locations across the country. About 30 years ago, in fiscal 1993, Home Depot operated just 264 stores and generated $9.2 billion in annual sales. Today, there are 2,337 locations, and the business ranked in $153 billion in revenue in fiscal 2023. Okay, uh, today this is about it, and I might have to go to sleep. Okay, see ya, and have a good night, and bye bye, everybody.